Hello there, Wealthpress subscribers and viewers. Welcome to another midweek update. I'm here with Roger Scott on this holiday week. Roger, how are you?
I'm doing great. Thank you for having me here, James.
Last week you gave us a few stock picks, and I was happy to follow them this week. And 3 out of the 4 are up anywhere from 5 to 10%. One is just down slightly, but Trupanion especially has really outperformed in 1 week, up 10% to $47 here. So that's great. Congratulations.
Thank you. Thank you.
And are those trends and those stocks, is that something you expect to continue? You mentioned that you expected this week was going to be more or less a quieter week, an indecisive week in the market. Certainly that's the case. The Bang Plus stocks are up a bit today. Gold has been strong, but it's an irresolute week. It's like nothing's really happening.
Yeah, I tend to find that I call them fragmented weeks, and it actually really bothered me. Not 4th of July, because 4th of July is a very legitimate. It's one of the big holidays. But anytime, James, anytime, especially beginning of the year, you have these holidays, these one-day holidays, and they fall on a Monday. It just destroys the entire week. So anytime you have a day off, regardless of the holiday, Monday, Wednesday, Friday, the week just completely gets destroyed. Large hedge fund managers take the week off. They've got their junior guys there, and the junior guys are very, very hesitant to put big trades on. So it creates just a lower liquidity level. So anytime I see markets doing something wild or trending instead of just being choppy like we are this week, it usually 85% of the time it gets completely reversed over the next few weeks. It's kind of like retail volume does not have the sustainability like institutional does. So there's only so much. There's only so much momentum they can generate, and then large hedge funds see that, they come in next week and they tend to arbitrage it. So a good rule of the markets. You could tell I went to law school. Good rule of law. Good rule of the markets is to typically shake off the trading action that occurred on holiday weeks, especially big weeks like Christmas, New Year's Eve, Thanksgiving, 4th of July, the Independence, the big holidays.
Okay, so we saw, though, in spite of this being a quiet week, the jobs numbers came out today. 4 million new jobs created in June, completely exceeding expectations, and the unemployment rate falling to 11.1%. That's lit a bit of a fire under like Tesla, who also reported exceeding second quarter delivery forecasts. So are those sort of gains in the marketplace, are they going to be amplified next week when the larger institutions come back to work full time, assuming they do, although it's July, so who knows?
I don't, a lot of things seem maybe, but only for a few more days, maybe for Monday and Tuesday. But then I believe momentum and earnings are going to start driving the market. We're still having a slowdown with COVID-19. Economic data is really great, but you're looking at this data in comparison to extremely negative revisions. Okay, I mean, let's be real here. We were expecting earnings for this quarter to be about 22% positive, and we're at 42%, 24 positive, we're at 42 negative expectation. So all of these numbers are great. They're wonderful. But again, they're completely in light of what happened. And it's going to take the world a little longer. Look, we tried to bounce back to just a simple lesson in humanity. The world tried to bounce from this February. The world tried to pretend this COVID-19 is nothing there. And look at what's happening now. Parts of Florida, parts of Texas, parts of California are being restricted again. Masks again. The fact that economy is good isn't really that big of a driver, because if we have a true second wave going, it's going to collapse the economy again like it did in February. So I think it's too much too fast, and I think it's going to catch up to us. I think when we have a really good understanding of where earnings are this quarter, and we're going to be there in about a month, we're going to be very cautious and we're going to be a lot more pessimistic. Right now, we're still trying to, hey, let's recover. There's still a chance. We could still pull through this. But I think that's not a reality because we don't have a vaccine. People are still dying. We have daily rates that are really crazy. So I think all of these numbers that we're seeing are we have to kind of look at them through a filter.
Mm-hmm.
And I think you're still going to have premium. You're still going to have funds buying up really good stocks because those stocks are impacted positively by COVID-19. Like the stocks, like the stay-at-home, Chewy, Trupanion, those type of stocks, those are going to be increasing. And my philosophy right now is I don't know how long it's going to take for COVID-19 to end. I don't know how long it's going to take vaccine to come out. But I do know this. I know that there were certain companies that were heating up before COVID-19. And I know that there are certain companies that are in a better position because of COVID-19. Why should we second guess ourselves? That's enough right there. That's how I've been trading over the last 3 months, and it's been amazing. We've been we did our accuracy over the last 150 trades. We had 85% went up versus down from the time we called it. If we can get an 85% accuracy with this kind of a logic, why should we try to second guess and figure out what's going to happen again? Why can't we just stay with the present? You know what I mean?
Mm-hmm.
Gold is going up. Energies are starting energies at that $40 level. So I am becoming a lot more defensive. And I actually believe that the second part of the year, which was just started yesterday, ironically enough, I think we're going to see a lot more of a lot less reactory trading and a lot more, hey, this is really hurting us. We're going to come to reality. I think that's what's going to happen. I think reality is going to set in over the next month or two. And I don't think the market has been realistic in the way it's been trading over the past few months. I think finally it's going to settle in and we're going to see a lot more choppiness, a lot more defensiveness, a lot more gold and defensive assets, maybe utilities moving up. By the way, interestingly enough, utilities is the only sector, James, in the S&P that's not projected to have negative revisions. In other words, it's the only sector that's going to be positive. Even the tech is expected to be down 13 to 15% by the end of this quarter earnings. But utilities has got a positive outcome. And right now, again, I'm always looking ahead. And right now I'm seeing that bumpy road ahead. And I'm looking at gold stocks right now. And I actually have a couple for you because I know you're the gold man. So I wanted to see what you think. And if that's okay, because,
Absolutely. Funny you should say that. My premium letter and the James West letter this month is all about gold and learning how to understand what is driving gold. And so I put that as the main theme of my July letter because I'm by way of explanation as to why I'm so focused on picking gold stocks. So I'm interested to hear which ones you picked.
Well, before we get into it, I mean, let's just get a little broad first. And look, we've got gold spot prices have been going up third straight month. Okay. Spot gold a few days ago was just $8 away from an 8-year high of close to $1,800. Spot gold is heading for the biggest quarterly rise in 4 years. Okay. Yep. And as long as that COVID-19 cloud stays over our head, whether it rains or shines, but if it stays over our head, I think gold is going to go higher. So I am looking at some gold stocks, and I like the way gold is looking technically. So that's what brought me into these stocks. So the first stock I'm looking at is Agnico Eagle Mines, ticker symbol AEM.
Yeah,
they're looking really, really good. I like their numbers. Their numbers were up 40% against a year ago quarter.
Yes.
They're operating in Canada, Finland, and Mexico, so they have a good worldwide diversification. Their revenue was substantially above earning estimates. They beat EPS by 3 cents. They made revenue was $671 million, above 652 consensus. And technically, I like how the stock is holding up right now.
Yep.
Okay. So that's the first one. Okay. The second one, I think you may find interesting. The first one was kind of like one of the bigger ones, but I think you'd find this one interesting. Please tell me what you think. Okay. Wheaton Precious Metals. Have you heard of them?
Oh yes, yeah.
Oh, okay.
Very, very well. It's an interesting. It's a royalty play, more or less, correct?
Well, they use a streaming business model. In other words, they don't mine themselves. They buy miners. That's it.
Right. Yeah. Well, that's a great methodology, and in fact, a lot of the royalty players in the gold space have adopted more of a streaming revenue model, which is really just another form of royalty. But instead of being a royalty on the gross revenue of a mine or the gross production of a mine, it's a continuous incremental royalty against production with a fixed discount to the gold price that gives absolute ultimate upside to the shareholders in those companies. So I think that's a great pick. Those are very good safe picks for portfolios more oriented towards capital preservation as opposed to value growth. But in a rising gold market, they both have the potential to deliver to both strategies because, hey, it's a rising gold market, and they both tend to perform with a, percentage beta to gold improvement in performance. So I think that's a good solid pick. Yeah.
Well, the last 4 quarters have been seeing higher momentum. They've been outperforming. Their numbers are looking very solid, and I love how they're looking technically right now. Both of the companies are looking really, really good technically and fundamentally. And what I really like about the stock is they issue dividends, which is kind of interesting for a gold company. They seem to be doing a lot of things right. So I like how they look technically. And I'm not going to pretend to be a gold expert. I'm a trading expert, but I'm no gold expert. So I thought it'd be interesting to kind of bounce these two off of you and kind of get your feedback off of them as well. And so you and lastly, this is what I wanted to say. Gold stocks have been since we've been the last quarter and a half. Gold stocks have been outperforming the metal itself about 4-1. So if gold tends to go up, these two stocks, which are as James is putting it here, more or less kind of conservative blue chipper type of stocks for gold market, they should go up as well.
Yeah, definitely. A 4-to-1 ratio in what I call asymmetrical exposure to gold, where you anticipate a superior beta performance to the gold price itself. That's really the underlying theme of my my July letter. And I'm not going to go into the companies that I've discussed in that letter in this session, but the essence, the theme of the letter is about the asymmetrical exposure to gold available through playing different derivatives of gold itself, like stocks, equities, royalty streaming deals, and junior miners. So it's an interesting read. It warms my heart to know, Roger, that you, a trader, are gravitating towards gold because the technicals tell you that gold is where the action is. So from a fundamentalist perspective, it often intrigues me how often the technicals justify the fundamentals and usually sort of give a harbinger of notice that this market is moving. The technicals will show you that first and draw attention to the fundamentals, which is what happens in my case, though I tend to arrive at it the other way. I end up, looking at the fundamentals and thinking, boy, this is going to really start to generate some interest in the stocks, and I go look, and sure enough, the technical data bears me out. So that's where I think it's great to have a good sort of information flow from both camps: technical trading oriented, and as well as fundamental investing oriented.
I couldn't agree with you more. Lastly, before I let you go, or before you let me go, I wanted to ask you one more question about gold, if you don't mind.
Sure.
And because again, this is important for our readers, because again, I think we're going to see a heat up in gold, and I think my equity traders should start focusing on metals. Silver and gold. What do you think about the rumor we're hearing, or I don't know if it's a rumor or not, but about the fact that China is starting to store a lot more. They're starting to increase their gold reserve quite a bit.
Well, I mean, that's arguably well beyond rumor. There has been a trend in the bullion market for gold to be moving colloquially within the industry from west to east, whereby the Western holders of large bullion stores have been willing to sell them to the Chinese as gold was getting cheaper over the last few years, as they abdicate their faith in gold as a safe haven in favor of the US dollar. And China has only been too happy to suck up all of that gold at a discount. And so that has been a very general migration occurring since gold started to head south in 2012, 2013, 14. So that's not a rumor. That's the way it is. Now, I caveat that with, of course, the idea that China's data is opaque at best, and so you never really know what's happening. But I think that there's a returning interest to the Western safe haven trade for gold, because the US dollar has demonstrated that there's more risk in the US dollar than there is in gold. I mean, the US dollar tier one equity on the balance sheet of the Fed increased by $2.3 trillion in the last 3 months alone, which is a 50% increase over the last 10 years in tier one equity on the balance sheet of the Fed. And that tier one equity is fractionally banked out to a multiple in currency of 8 to 12 times. So if with each fractional banking exercise, the tier one equity is amplified by 8 to 12 times by each successive bank, one could argue that the inventory of currency in which gold is measured has increased by 500+% in the last few years, whereas the supply of gold relative to US dollars has barely increased at all. And that fundamentally, more than anything, is the mathematical explanation behind gold's strong support at these levels and continuing, I believe, through $2,000 and beyond into 2020.
Right. And the charts agree with that completely.
Mm-hmm.
So
yes.
yeah. So I am looking. Well, I appreciate you explaining that to me. Again, I don't pretend gold expert. I am a trader, but I'm not a gold expert. But this is all very interesting, and it's good to know that what you're seeing and what I'm seeing from two different perspectives is aligning in the same direction. And Jeff, by the way, we were on with Jeff earlier in the week. He sees it as well. He mentioned several times that he would actually feel more comfortable buying gold if it went sharply above 1,800. He'd feel so. Yeah. And another interesting thing that's setting up technically is the energy markets. It looks like we're right above the $40, and it looks like we're going to start going higher, which should give support for some energy stocks in the coming weeks. And I think that's going to be interesting because energy tends to rise when U.S. stock markets tend to kind of naturally deflate a little bit as well. So I think we're going to be seeing some of that too.
Right. And I wanted to ask you, Roger, about the Fed announced that they launched on June 30th. So on Tuesday, they announced the official launch of their first special purpose vehicle that was going to give them the ability to be the primary lending credit facility for large corporate employers. And now here we are at July 2nd, 2 days later, and the Fed has announced that 5 airlines are going to receive a loan package worth $25 billion initially, with an additional $25 billion being added for various other elements of that sort of bailout. So my question for you is, does that mean that airlines are a buy if the Fed is going to step in and basically put a floor on the value of airlines by being the lender of first resort, never mind last resort, for airlines directly? That's my first question. The second part of that is, does that constitute an unfair subsidy in terms of the global airline market, which might result in some backlash against America on the trade front?
Both very, very good question. Well, no, to answer your first question, I don't think airlines are a buy. I think I think we're going to see a big reorganization in the industry. I think some airlines are going to be merging. I'm not there yet, but I think this is going to be a strong catalyst in the right direction. I believe certain airlines are going to come out of this and certain airlines will not. And I think the way the Fed is going to bail them out is just put in their agreement where they have to be bought out by another company. So I am not a buyer just yet. I want to see how the whole thing is going to shake out. And I ultimately think even if the Fed steps in with this COVID-19 right now, the process is going to take a while. So I would be a lot more comfortable waiting for the technicals to line up first before going in. I think it's best to be late to the party than to be sitting and having your money chewed up at the bottom and possibly going even lower over the next several months. In my opinion, because I think once they go higher, they're going to go a lot higher.
Sure.
But I'm not there yet. Now, the second question is a very, very interesting question. And yes, I think there's going to be a lot of backlash. I think there's going to be a lot of issues. I think Europe is going to cause a lot of issues. I think we're going to have a lot of issues from Asia. But yeah, I think this is going to become, I think the Fed is going to give U.S. airlines an unfair advantage in the marketplace. And I think there's going to be some global agreements, but I don't think that's going to happen yet. And I think that actually may be used in the future as a political wild card.
Mm-hmm.
But yeah, that is a very interesting issue. I think, honestly, James, here's what I think the Fed should have done. I think it's very dangerous to favor an industry over another industry. And the airline industry is let's just say in the past, they haven't been using these grants and loans the right way. Okay. There's a lot of money that went to management and supposed to airlines and employees and so forth. So I think one of the things that Fed is trying to do is regulate how the money gets spent a little better. But ultimately, I think this is going to create an unfair competitive advantage for U.S. airlines in the world. And I think it's going to be a big mess.
Yeah, that's interesting. Well, we'll continue watch. At this hour, the airlines have, they're pretty much fluctuating around break even on the day. So not much of a response to that Fed announcement, which was merely 10 minutes ago. So I'm tending to think that you're right. There's not going to be a rush into the airlines, even though that was my first expectation, was to see some strong uptake as a result of that announcement. Though I guess being a short week, and I guess probably more people are of your opinion that it's better to sit and wait and see what happens.
You got to understand, institutions really are on the sidelines. I would say right now there's about 15 to 20% of institutional volume, and it's all going to come back into the market next week. Even with these employment numbers, we didn't have a spectacular. I mean, markets started going up, but the volatility is just not there right now. And I don't think the summer has much to do with it because it's an election year. Usually, summers are actually fairly volatile during election years, and the cool off begins as the summer ends and the fall begins. That's what we saw last election cycle, because traders don't know for sure which way things are going to go, so they start backing away in a bigger, more of a bigger scheme of things. But that doesn't usually happen till about end of September, early October in election year. So we still have some time to go.
Right. Okay, Roger. Well, fantastic update as usual. We'll leave it there for now, and I look forward to talking to you at the round table on Monday. Have a fantastic 4th of July weekend.
Thank you for having me, James, and get some rest, and I'll talk to you soon.